Okay, well, we've got Jahangir Aziz now joining us, Global Head of Emerging EM Economics at JPMorgan. Jahangir, good to have you with us here. Thank you very much for your time. You know, it's that time of the year when I think outlook reports for 2024 are coming in. Not thick and fast, but they're starting to trickle in. And I think from what I've seen, what's top of mind is how the largest economy will fare. Will it be really... so there are two things. One, of course, is the belief that the hiking cycle is done. And second, what next? Will it be a sort of, smooth kind of transition? Or will there be, some rocky waters? So I just want to start by getting your thoughts there, Jahangir. How's it looking?
So look, in the U.S. economy, and you're right that, all of us would want to take out, publish our outlook before Thanksgiving Day. So we just published our global outlook and a U.S. outlook. Tomorrow I'll be publishing my emerging market outlook. So look, in the U.S. economy, we have a baseline, and the baseline is that of a soft landing. And we are attributing, a reasonably high probability that can be achieved. And alongside that, the Fed, in that view, the Fed remains on hold till about, around June, and in the second half of the year, we have about 100 basis points of easing. So that's the baseline view. But alongside that, there is a view that talks about, and has a material probability to it. And that's the view that, look, it isn't going to be that easy, as you were alluding to. And not only will it be easing, the economy might be running much hotter. Employment numbers might be coming out much stronger than what is required to deliver a soft landing. And of course, with that, there is a possibility that inflation could inflect, bringing back the Fed into action sometime between now and 24. Again, middle of 24. But again, these are very uncertain. I mean, there's nothing really that can pin it down with some degree of certainty. And I think, therefore, between now and I would say the next 6 months' time, I think the data flow in the U.S. economy will be, as we call it, observationally equivalent. It'll be observationally equivalent to a soft landing and observationally equivalent to a hard landing. And I don't think that data is going to break in any particular direction that will allow us to identify whether we are in the good branch or on the bad branch.
Okay, just stand at the observation deck for now, right? For the foreseeable future. Got that. Jahangir, hi, good morning and greetings of the season to you. So just to reiterate, you believe that the second half of 2024 is when you're expecting 100 basis points easing of rates, correct? From the US Fed.
Yeah, that's good. That's the baseline.
Got it. That's the base case. Okay. Do you expect the RBI to hold rates as well till it clearly cites the Fed heading to cut?
I think RBI, along with all the other Asian banks, I mean, if you just look at the Asian central banks, right? They are the ones that did not raise rates as much. So the interest rate differential with the Fed funds rate is probably the minimal. It's at almost like a 15-year low at this point in time. And it's not just the RBI, it's Bank of Indonesia's BSP, it's Bank of Thailand, everyone. And that's because inflation wasn't really as big a problem in Asia as it was in Latin America or in Europe. And I think, but that very shallow, premium over Fed funds rate is going to hold all of these Asian central banks, including the RBI, from cutting, even if inflation comes down or if growth slows down, which is not the case in India. But even if growth does slow down, and I don't think any one of them are easing unless they actually see the Fed doing the first cut.
All right. Hi, Ms. Aziz. Good morning and good to have you. And, I was going to ask you what's the outlook for the next year. But as you said, you'll be publishing your note tomorrow, I think. So we'll have to wait by. Because sometimes the rate hikes, they take place, but the impact is felt in the next year, particularly for emerging markets. So we'll wait by for that. But three asset classes, which will be very, very important from an India equity market perspective. The yields. Do you believe that, the 10-year yields have peaked out at around 5%? The dollar index as well, was around 107. We were a little bit worried. And Brent crude prices. So on these three asset classes, I mean, do you think that we have seen the highs for a while?
Right. So let me go by the reverse. So, Brent crude prices, if you look at fundamental demand and supply. So let's leave geopolitics out of this right now. So if you look at the fundamental supply and demand, You will need OPEC to cut really, really deep if they want, oil prices to, replicate anything that happened this year. We are looking at, we don't think that is, a base case for us. And without OPEC cutting, oil prices look to be around 85, 86 in the first half and closer to 80 in the second half when, global economy slows, US slows much more materially. And so for the year as a whole, we're looking at 83. Now, again, geopolitics can turn that upside down, but so far it's been very well contained. And so, again, to us, geopolitics or impact of geopolitics on oil prices is a tail risk rather than a baseline. And our baseline is that, as an average, we will probably do somewhere in the low 80s. On the 10-year, yeah, I mean, the 10-year looks as if it has peaked out. We have the 10-year going down from the 460s average for this quarter right down to 375 by the end of 2024. But again, this path is contingent on the Fed delivering 100 basis points of rate cuts in the second half of the year. If that rate cut does not come about, or if growth surprises on the upside, and remember, throughout 23, growth has surprised us on the upside in the US, and as a result, that term risk premium has been added on. I think that if that doesn't happen, if we do get our Goldilocks scenario, which is nice soft landing taking place and 100 basis points of rate cuts in the second half, Fed fund rates, the 10-year rate should be around 325. And if that happens, 375, sorry. And if that happens, then I think in the second half of the year, you could see, dollar actually weaken considerably. We have dollar euro probably going towards 110 to 115 in the second half of the year, even though in the first half of the year, it'll probably be around 105.
All right. Thanks a lot, Jahangir, for joining in and, making sense of all the data points that we've got so far. Have a great day. We'll chat with you again very soon. So that's JPMorgan talking about a base case of 100 basis points rate cuts from the US Fed starting the second half of 2024.